everyone. Delighted you could join us today for this panel discussion, snappily entitled Structural Considerations of Assorted Risk Management Strategies. I'm delighted to say I have a fantastic panel with me today. Between them, I added up, although I am an actuary, so be careful of my adding up, but I added up that they oversee over $250 billion of liabilities, either within the insurance company they represent, in Jay's case, or the pension funds they represent. So a very credible and significant panel I'm sure you're looking forward to hearing from. My name is Paul Kitson. I'm a partner at PwC. I've been active and involved in the longevity market for a number of years, but I will not say very much today other than to ask questions of my panel. I'm delighted I'm joined by Paul Rogers from BT, John Chilman from RPMI, Jay Shah from Pensions Insurance Corporation, and Guy Coughlan from USS. So I'm looking forward to a wide-ranging discussion today across all of the risk management structural sort of offerings that are out there. I was going to start with Paul, if I may, and I wondered, Paul, if you can share from your BT experiences some of the ways you've thought about managing longevity risk and some of the things that have happened in the scheme in your time overseeing it.
Yeah, I mean, happy to. And it's been a development in how we've thought about things over time. And I suppose the first part to call out is back in 2014, we undertook a transaction, the BT pension scheme, that was insuring around 16 billion of liabilities, which was the biggest transaction at the time. People on the panel probably know better than me if that's still the biggest transaction, but a very large transaction at the time. The pension scheme set up its own wholly owned insurance company to do the transaction. They insured the risk with that insurance company, and that insurance company took out reinsurance, in this case with the Prudential Insurance Corporation of America, really on a straight back-to-back insurance and reinsurance approach. And the way that was done allowed the scheme to access the insurance market, the reinsurance market directly. And I think since then, at the time, that there hadn't been many done that way, but I think that's become a relatively common way of doing transactions since then. So that's the first part, and I don't know, Paul, if there's further questions on that you had before I sort of delve into how we thought about that transaction and the risk and how we've moved forward since.
Yeah, no, let's keep going. I'd be really interested to hear how that then sort of moves on from then.
Yeah, so I think, I work on the company side for BT, and I was with BT from 2011, so I was fully involved in that transaction, which we did with the trustees in 2014. And I think at the time, the trustee was very much of a view that over time, longevity risk would become one of the biggest risk factors in the scheme as we moved towards a more de-risked long term. And they were keen back in 2014 to make a start on reducing some of that risk. Clearly, as a big scheme, you're not going to do it all in one go. And as a corporate looking at that, at the time, the focus we were looking around the cost of the insurance that we'd be needing to put in. And in our assessment, we looked at and agreed with the trustee that the trustee would seek to take a little bit more investment risk to mitigate the extra costs. And from our perspective, it wasn't much more. I mean, it was probably, I think, less than 1% of equities that needed to be increased to pay for the insurance. The VAR metric, value at risk, was broadly similar before and after the transaction, and that got us comfortable as a corporate that it made sense as a transaction. I think from that point, our way of looking at risk has evolved. We, over time, have since 2014 tended to look at risk in a number of different ways, not just VAR, but different scenarios, sensitivities, etc. And I think our focus moved towards more looking at, if we had £1 to spend on risk reduction, where would we spend it? And one of the areas where we felt best spending of that pound over that period was in terms of reducing the equity component down and really taking a view that that was the best focus. And that's what we've, as a scheme, working with the trustees, done, is reduce that investment risk down. I think now where we are today, we're still on that journey, and we're really assessing longevity risk once more right now. And some of the metrics we're interested in, I wouldn't say we've concluded yet, but we're looking at how longevity risk might hit us over the lifetime of the pension scheme, but not just how big might that risk be over time, but how does it manifest? How does it come to hit us? And as a corporate, we're often focused on that 3-yearly valuation cycle, and where might you have a sudden demand for extra, where there's an extra deficit that arises, perhaps because the actuarial practice has changed to recognise a new table from different experience. So I think we're really quite interested in assessing how that lifetime risk can hit you in a 3-year period, and how much we can do to mitigate that.
No, thank you, Paul. That's really interesting. And I have indeed heard people refer to longevity risk as scheme actuary risk over the short term. As you say, that sort of change in assumptions is the short term exposure, although one would hope that the short term tends to the long term. Thank you, Paul. I'm sure we'll come back to you a little bit later, and in particular kind of maybe hear about any sort of learnings from those previous transactions or the experience since. But I wonder, John, if I could bring you in. Obviously, you've worked with a number of schemes kind of over the last few years. I'd be interested in the lens you've applied to it, and also actually interested in whether, as you went from scheme to scheme, they have a different way of thinking about longevity risk depending on the employer or the circumstances. I'm very interested in your unique insight, having sort of been operational in a number of different funds.
Yes, so whilst I'm now the CEO of RPMI, which effectively looks after the railway scheme, I've largely been on the corporate side for most of my career. And the most significant input into some longevity risk hedging was in my previous role in National Grid. And I think effectively we look at things a very similar way to BT, some slight differences. So let's take you to my current job. In the rail scheme, we've really seen it as part of a bundled exercise, longevity risk, to take out as we're buying out. So effectively, we're taking out the interest rate, inflation, we're taking out all those risks at the same time, but with relatively small sections, relatively small schemes. And I think you can do it at that point in time. When I look back at National Grid, very different scale. So talking about sort of £20 billion plus schemes. And we were really saying, what are the most appropriate tools we want there? Recognising that those schemes were much more mature. They were already on the de-risking of the asset side, and increasingly longevity risk was overtaking the asset classes as being the most significant risk. But also we had to look at where's the relative funding of these plans. I had two big plans, a 20 billion gas scheme and a 4 billion electricity scheme. Now, the gas scheme was very mature on some quite conservative basis. So the option there was that we could afford to go down a buy-in route as opposed to just a longevity swap route. So that is taking away the inflation, the interest rate, and the longevity risk as a single solution, potentially as a part of a phased process to move to a buyout in the future. Those transactions are becoming increasingly common, the volumes going up year on year. One of the advantages we saw on that particular transaction was that the documentation and structure was a little simpler than it is for longevity risk. The longevity risk hedging is quite complex documentation, and actually for a buy-in on its own, that was fine. We could do that for that gas scheme because we had sufficient funding to do that. The electricity scheme was also keen to do something there as well, but its funding wasn't in the same state, and actually it needed to rely quite significantly on return-seeking assets going forward. So we weren't going to be able to just swap some of our gilts for a buy-in type solution. So at that point, we did go down the longevity route, hedging largely all the pensioners in the scheme at that point in time. So that was a much more complex structure to put in place. In fact, it took us about 6 years from start to finish, because actually we had to get the rules of the scheme changed, and the electricity scheme is one of these multi-employer schemes with its own sections. It wasn't a straightforward process. We were fortunate that we managed to get funding for that in the valuation. And as a regulated industry, we had to get Ofgem to agree to that as well. And actually, when we came to the transaction, the timing was quite fortuitous that we were able to release that provision. And also we got a slight profit on the transaction as well. So it was a great position for the scheme were delighted, the trustee were delighted. From an employer-trustee relationship, we did work very closely. We both recognised this was very good for us and for the members in the long term. And so to find a solution that worked for us at a cost that was appropriate was good. So both parties were delighted, both on the gas and the electricity side with the solutions.
Thanks very much, John. That's very interesting, very helpful. And maybe on that, you highlight the sort of different solutions that are available from buy-in, moving towards buyout, and longevity swap. Maybe at this juncture, I can bring Jay in. Jay, obviously, a pension insurance corporation on the provider side. It'd be really interesting to get your take on this and your observations on the different solutions that might be right for different funds. I mean, do you have a sense as to whether obviously we've got a couple of very large funds represented today. Is there a size component to this? It'd be really good to hear your take.
Well, two things. I mean, of course, us as an insurance company, we're big users of longevity hedging, largely through longevity reinsurance ourselves. Maybe I'll come on to that in a moment. But in terms of buy-ins and buyouts versus longevity hedging, longevity swaps, I mean, generally what we see is that for the very large schemes that have the infrastructure to be able to manage the asset side of the essentially the risk portfolio, they just have the scale to be able to manage that, have the expertise in house, be able to source different asset classes, and in effect be able to operate pretty much in the same way as an insurance company might. And clearly the focus there is on hedging the risk that can't be controlled through the investment markets. What we find, however, is that for sort of smaller schemes, and by that I mean I include schemes that are still in the sort of the billions of pounds, low billions of pounds. Frankly, they and particularly as they become more mature, and ultimately will get smaller and smaller in size. They just haven't got the scale and the resource to be able to manage both the longevity risk and the asset risk. And for those pension schemes, I mean, generally, pretty much as John said, for one of the smaller schemes, a buy-in or a buyout seems to be a more sensible kind of approach because you're passing up both the investment risk and the longevity risk. So that's what we tend to find. I mean, interesting enough, if you look at the current environment with everything that's going on with COVID-19, actually the thing that is causing most disruption, whether it's in pension schemes or insurance companies or the financial markets, it's not the longevity impact of COVID-19 that is the forefront of people's analyses. So it tends to be the financial risk that the smaller pension schemes, mid-sized pension schemes, tend to focus on. I mean, from our perspective, taking on longevity risk as part of bulk annuities generally, that's a significant risk that we're taking on. We have a huge amount of expertise in house, but we very much take the view that we don't see longevity as a profit center we tend to want to hedge it out to the extent we can. We kind of see it in a way that others might see inflation risk. It's not something we want to particularly form a view on that we want to put our capital to work with. Instead, we want to hedge it out with the people who kind of naturally sit most comfortably with that risk, which is the reinsurers. Solvency II that came in a few years ago has pretty much kind of pushed most insurers in that direction. In any case, in the Solvency II requires more capital to be put behind any longevity risk that you retain than makes kind of economic sense. So most reinsurers, most insurers, most annuity writers will reinsure as much of their longevity risk as they can. It just kind of makes sense. So that's the view from the insurance side.
And do you think, I'm interested, Jay, do you think it's helpful to you as you think about longevity and managing that longevity risk, that there's a sort of dare I say, a clearer framework for insurers to think about risks than there is in pension fund land? I'm just interested that, as you say, there is a Solvency II, for right or for wrong, gives you a way of thinking about longevity risk. Is that helpful? Do you think if pension funds had more of a clear direction as to how they should think about risk and the tests they should perform, dare I say it, even the reserves they should hold, that would help? Or is that not necessarily something that you do find useful from Solvency II?
I'm not sure it is. It kind of solves everything. Prior to Solvency II, under the previous system, Solvency I, it was a much more nuanced economic balance as to whether you reinsure, remove the longevity risk, but pay the reinsurance fee, versus retaining that risk and holding the additional capital. But even in that solvency regime, we were choosing to reinsure longevity risk primarily because we just saw it as unrewarded risk. It was something that we, as I said earlier, didn't want to take an economic view on. So we've always reinsured. What we found over the years is that more and more capacity amongst the reinsurers has come to the market, that the market has evolved. It's probably somewhat easier as between insurance companies and reinsurers than it is between pension schemes and reinsurers, because we're doing it multiple times with each of the reinsurance partners that we have. We have established sort of contractual frameworks, so we're layering on more and more business with each of our reinsurers. So in that sense, it's a lot easier. We tend to, or at least reinsurers prefer us to go to them when we can be confident a deal is to be done, and they place a lot of value on that. But there are still some aspects of the longevity market which are still quite clunky. We'd have hoped that we would have a much more streamlined solution from a contractual legal perspective than we have at the moment. Each of the transactions we do are still to a certain extent, negotiated on a case-by-case basis. There isn't the equivalent of an ISDA in the longevity swap market. We're moving tentatively to some level of standardization of contracts, but we're not kind of there yet. Reinsurers will still want to look at each scheme and each opportunity on its own merits, look at scheme-specific aspects. We haven't made much progress to that sort of, reinsurers offering some sort of index-based approach, which can be operated quickly and smoothly. There's still very resource constraints. Great for them. So it's still a bit clunky, and in the sort of the deferred space, capacity is still quite sporadic and unpredictable. So we're not quite there in terms of having a perfect solution, but certainly insurers are probably in a better place to be able to manage the longevity risk through reinsurance than a lot of pension schemes.
No, thanks, Jay. That's really helpful, and I'm sure there's a few things we'll come back to a little bit later there. I'm going to try and come to Guy. Guy, I'm not sure whether you're either sitting very still or the video is freezing a little bit, so I don't know if you can hear me or not. But Guy, obviously, both at USS are very large funds, and obviously you did a lot for the longevity hedging market in your work at JP Morgan back in the day. If you can hear us, it would be great to hear your take on how the longevity hedging industry has sort of moved over the years that you've been involved with it, and perhaps be interesting to hear some of the things that you'd like to see. I think I did talk that up a little bit by hinting that Guy maybe couldn't hear us. So hopefully we'll get Guy back and maybe come to him a little bit later. In which case then, Paul, maybe I can flip back to you. you were obviously one of the sort of early movers in using a captive and using that structure. That's obviously been used by a number of pension funds now. It would be great to hear a bit more about that, about any lessons learned. I mean, obviously the world has moved on a little bit. I guess, are there any things for other pension funds or corporate sponsors coming at looking at hedging now that you learned from those early transactions that would be sort of useful to share?
Yeah, and it's always flattering that people still want to talk to me about the transaction we did back in 2014. But I always have to remind people it was 6 years ago. And my memory is not always perfectly crystal clear on what happened back then. But I guess some of the key positives for us were working closely with the trustee, and we went through a lot of the legal documentation and negotiations with the reinsurer together as one. We had a joint working party, and I think it is important that company and trustee work together on these things. So that was certainly useful. We were very clear also up front what we were trying to achieve with the transaction, what our red lines were in terms of the negotiation. And I think that was agreed between company and trustee early on. So I think that worked well. The challenges were largely linked to this being pretty new at the time, and setting up a very new process internally to run the longevity swap. Just really having to explore the best jurisdiction for the captive. And how to really do that deal in itself. So there was quite a lot of time spent doing it, but nothing out of the ordinary. And perhaps I suspect it would be a lot smoother process. Although perhaps some of Jay's comments suggest it's maybe still not quite the easiest process to go through.
And how, Paul? I'm really interested in how you found the sort of captive domicile and that sort of Guernsey position, and it may be that it's a sort of pension fund that do a lot of running of that. I still meet, as I talk to kind of clients and people in industry, very different views of, concern about using a sort of domicile like Guernsey and what that might entail, versus people who are now very comfortable with it. And indeed, a lot of corporates have different P&C risks running through captives. I'd just be really interested in your take on how critical that sort of part of it is, that sort of intermediary stepping stone.
Yeah, I mean, it was very important to both us and the trustee up front that we agreed something that we could get comfortable with from a risk and fear also of were we going to be criticised for doing something that we couldn't get out of. So I think we were comfortable. We spent a lot of time doing due diligence on the right jurisdiction for the captive, and ultimately we felt comfortable with the risks involved in doing that.
Thank you, Paul. That's very helpful. So I think we've got Guy back with us. We can hear from him. We may not be able to see him, but Guy, I don't know if you heard, and I'll sort of maybe save your blushes by doing it a bit quicker. But just you've been involved with the longevity hedging and thinking about longevity risk for a long time, starting off with your work at JP Morgan. So I'd just be really interested in your take on, how the longevity hedging industry or thinking about managing longevity risk with different mechanisms has kind of progressed. And interested in your take maybe actually on some of the things that you thought we might have now as sort of structural answers that maybe we don't yet. Oh, that is if you can hear us, Guy. Are you online with your mic on?
Yep, Paul. Yes, Paul. I hope you can hear me.
Yeah, we can hear you now. Thank you.
Yes, I think. Great, thank you. I think of innovation, in fact, has been built on innovation, and we've seen it in longevity swaps themselves, capital markets and insurance formats coming through. We've seen index. We've seen different formats, captive insurers, limited recourse, full recourse insurers, and a lot of analytical innovation around the method of hedging and the ways of interpreting and assessing hedges. Missing in terms of facilitating more deals, and one is it's very important. Secondly, the facilitation of easier transfer to the capital names. And then thirdly, much easier syndication of longevity risk in the reinsurance markets. Easier from the perspective of the hedging entity, the cedent of the risk. I think there could also be some more creativity around the area of collateral and collateral management, and the need to make this work with some of the complex structures that are currently being used, such as captive insurers and what have you. So more innovation, yes, would certainly be welcome, along with something like more standardization to help oil the wheels and facilitate this as a risk transfer market. But ultimately, it's a market with a number of barriers. Initially, the lack of expertise on the part of pension funds. Secondly, the long time scales of transactions. It just takes an enormous amount of time to get these transactions done. We've seen it there's also a high degree of complexity around documentation, around processes, and particularly around the collateral side of things. I think these are the four things that we need to address to help facilitate the innovation and improvement in the marketplace.
No, thank you, Guy. That's really helpful and well put. And I think we've managed to sort of avoid mentioning COVID so far. I'm sure we'll come back to there's some of those collateral points as we think about in a moment maybe what COVID might have done. But just before we sort of finish up on the kind of innovation point and where this may go, John, you again, I'm interested in your experience. Do you think there are things that you wish there were sort of available? Are there kind of product types that you think, gosh, if only we could do this? I mean, people have talked about things that maybe aren't kind of out of the money and more index-based transactions, those sorts of things. If those sorts of products were available from a sort of pension fund, corporate sponsor perspective, do you think there are things that would be used that people would be interested in?
Yeah, I mean, Jay picked it up very well when he said for the smaller funds, basically what you end up having is a buy-in or buy-out because it bundles everything together and makes it easier. There may be scope, if we have more index-type products, to say, actually, if you've got a blue-collar index and a white-collar index, is that sufficient you to just buy one of those and not need to go through all the massive complexity underlying the scheme? Now, I recognise that you need to get some pricing, you need to find a way of doing that, so data quality and various other things are important. But to find a way of making that more straightforward might give access to the smaller schemes in particular. And actually might make the whole speed of processing much more rapid, picking up on what Guy said about it takes a long time to run through those. So that would seem logically the most straightforward. I think
Well, I think John may have frozen on us. Maybe then, Jay, I can come to you. I mean, I don't know if this is something you'd have a particular view on, but obviously several in the insurance sector have sort of developed solutions that are sort of not quite the vanilla buy-in, if you like, but look to sort of work with the pension scheme earlier in their kind of journey, or look to sort of blur some of the edges between the full buy-in product. So maybe just doing the asset piece and leaving the longevity aside. I'd be interested in your take for that and the role for those sorts of things, and how you think about kind of innovation and products that you make available to funds.
I have to say it's a discussion we've had on a kind of with sort of a theoretical basis with several schemes quite often. What we tend to find in practice is, I mean, a very simple example of that would be, what if we insure with indexation, but without the caps and floors that apply to RPI. And whilst we've done that actually on at least one small scheme, when you get into the real sort of the nuts and bolts of it, trustees prefer just a clean solution which absolutely exactly mirrors the benefits that they have to pay to members, because ultimately that slight difference in coverage would need to be resolved at the point the pension scheme goes to buyout in any case. So we've tried to do that, but generally speaking, from a practical perspective, there's little appetite for it. What it's useful for is actually to start to help people think about what they want, the risks and their view on risks. So, for example, what's their view on pensioners versus deferreds, different age tranches of pensioners versus deferreds? What's their view on inflation risk versus other types of risks? So I think it's helpful sort of doing that sort of thing for the purposes of examining the underlying risk. But the market hasn't moved to some sort of index-based approach, whether it's for longevity or for benefits more generally. Well, I mean, we do find that insurers are happy to allow some level of basis risk between what we're taking on from the pension scheme versus what we're passing on to the insurers. Some simplification of benefits, but by and large, the indexed approaches, from my perspective, haven't really sort of taken off in reality.
Thanks, Joe. Yeah, no, that's right. And I'd be interested, if you don't mind me sort of putting this question to you in a sort of similar vein, as you say, in terms of, ultimately, if you leave some of these risks out, then you've got to sort of come to them eventually on the scheme's journey. Equally, more generally, some commentators have said that, doing a buy-in isn't necessarily always the best thing to get you to the journey to buy out. And presumably, I think they generally make that comment from, if you do all of your pensioners, then you've sort of left your deferreds to later. What's your take on that? Is that right in some circumstances? Do you have a sense of that?
I mean, generally speaking, if you think of a buy-in as essentially an investment decision, then it really shouldn't make any difference. So if you think of a buy-in as being a bit like an illiquid bond that wraps in longevity cover as well, well, that's a great product if you have already moved towards a largely bond-like investment strategy for a part of your portfolio, which might be the pensioners or the older pensioners. So once you look at it from that lens, it's a sort of a natural next step. Now, it doesn't address the deferreds. It's not intended to address the deferreds. You're absolutely right that it leaves those members uninsured. But what we've seen is that a lot of pension schemes have this sort of glide path where they're looking at the pensioners first, particularly the extent of holding gilts, with a view to ensuring the rest of the population, the deferreds, as they retire and get older, and the residual pension scheme becomes more mature. I mean, we've had certainly one of our biggest cases did a number of pensioner buy-ins, and they were in a fortunate position that they managed to get to a full buyout position, full funding to a full buyout much earlier than they were expecting. So it's not the case necessarily that if you do a buy-in, your buyout is still sort of 20 years down the line.
Thanks, Jay. That's really helpful. So I wondered, Paul, if I can come back to you. There was something you said earlier, which I don't know if it's something you can say any more about, but you mentioned You thought about longevity risk both in the sort of context of VAR, but also kind of scenario planning. I know that different funds think about longevity risk in very different ways, and it's not an easy thought process for funds to go through. Unlike the insurance sector, there isn't a sort of standard set of longevity tests that one can apply. I wondered, Paul, whether you could say any more about how you've been thinking about kind of longevity risk and approaching it, and helping you therefore sort of put it in the bucket next to other risks that your scheme is running.
Yeah, so I think the piece that we start looking at is the whole of the lifetime of the scheme, the risk that you could be exposed to if things go against or indeed for the scheme, and we look at that, and what you quickly realise is if that hits you gradually over time, it's not a particularly big issue. It will be a big number, but it's spread over, for us, maybe 70 years in the future. So it as a quantum over the lifetime doesn't look as large. But when you start saying, well, what we are prone to is these very big swings in mortality tables each year, and it always surprises me somewhat that one good winter or a bad winter can really move the life expectancy quite a bit. And we see big swings in our life expectancy assumption every 3 years, and indeed every year in our accounting figures. So we are being impacted by that swing a lot more, and that's the thing that as a corporate is really painful if you're suddenly at a valuation and facing a big extra cash demand that you weren't expecting. So what we're really trying to look at is that quantification of how you might be impacted over time, over a valuation, and that it's quite a tricky piece to look at, and you can be guided to some extent by the past, but it is clear that the mortality does move in these big shifts of sometimes actuarial thinking, actuarial tables just moving on.
That's great, and this may be an unfair question, so you could take the fifth on it if you like, and maybe just to give John notice, I'll put this one to you as well. I mean, obviously one can read. I was very fortunate to organise a panel discussion between Aubrey de Grey and Jay Olshansky, which was a great honour to have the two of them sort of debating opposite each other. But clearly, listening to them, one can see incredibly different bookends as to what kind of longevity could be. How do you, as a pension fund, as I say, maybe starting with you, Paul, and then coming to John, do you give a nod to those things? How do you think about some of those really extreme events? Do you just sort of put those in there? Well, if they happen, society's got big things to think about. I'm just really interested in your take on some of those more extreme sort of possible outcomes for the world. Yeah,
and I think in looking at those scenarios, we've certainly done some analysis on the basic, the sort of looking at different mortality tables, what they mean, varying parameters within them, but then also the more real world scenarios to bring it to life. What does a cure for cancer look like, etc. I think the Aubrey de Grey scenario is an extreme longevity scenario. We will look at some extreme, perhaps not as extreme as that one, but I think we are very keen in looking at that wide range, because it is those tail events that really can hurt a corporate and a pension scheme. Thanks.
John, to bring you in, I'd be interested in your take on this sort of longevity risk question.
It depends where you are. So I think when I was sitting there with my National Grid hat on, with effectively a scheme that closed to new members 20 plus years ago, your scenario is you're not expecting the Aubrey Gray 1,000-year-old man scenario to hit those people. So you have less concern about that. Much more concern within the rail scheme, where we're still bringing in 18-year-old new joiners into a DB arrangement that will, as Paul said, will be running for some time. So that is a significant. But some people there have been designs around that say actually we'll link state pension age, and as that is increasing, that will become the default pension age for retirement under benefits anyway. So if that was to move in this sort of scenario, you've got some sort of protection. But we still see them as extreme, and actually the weighting that we apply to those is minuscule at the moment. So it would be great if we had a cure for cancer, but actually my fear is that the whole well-being and longevity of individuals is more driven by how much they're playing outside when they're in their formative years, as opposed to playing on Xboxes. And so we're probably doing a lot more damage at that sort of age for the new DB members than we are sort of expecting a replacement of body parts and various other things going forward. You're on mute, Paul.
Thank you, John. I was hoping I'd be the one to point someone else on that. So I was just saying, and I may have this wrong, so do correct me if I do. But as I understand the rail scheme, there's still a link in terms of member contributions to kind of changing liabilities. Does that I suppose more direct link to what members pay change the dynamic in the way you think about longevity risk and sort of members sharing in it, or?
Absolutely, it changes the way we think about all our risks, because we have to have members paying 40% of not just the ongoing benefit accrual, but any deficit as well. So the scenario where you might say, well, it's great, let's pay it off in the next 5 years, if that makes a very significant to member contributions, you have to look at that. So we're balancing the investment risk, longevity, and all those factors together in terms of making our funding decisions. And also recognizing the fact that we have 108 different schemes effectively. They have a vast variety of investment strategies, benefit designs now. They all started the same, but they're now vastly different. And in terms of maturity, because of their structure. So you put that and you end up a lot of different scenarios, and it's how much you can give to each one. So, as I say, we've been chipping away at some of the smaller ones that are much more mature on their way to a sort of self-sufficiency, and if we can do it, can afford it, they will go through a buyout route. To be honest, we haven't taken the same action with our least mature plans. Those are the ones for the train operating companies, the trains you're going to go to work every day, simply because they're taking so much investment risk that the mortality risk, the longevity risk is quite a small element at this point.
Thank you, John. Very, very helpful. Guy, I think you're back with us now. Hopefully you can hear me, and hopefully I've got myself off mute as well now. So we've just been talking a little bit about kind of the way we think about risk. I suppose just to bring you back in on some of the latest points you talked about. The index approach I'm quite interested in, and you mentioned that kind of when you were talking about some of the development we have seen. Do you think there's more to come there? Is that a key part of where this sort of market is going and structures?
I think its day may have passed, Paul. I think index hedging was clearly an innovative idea and a very interesting idea, but we've had so few transactions of this kind, and I think the annuity approach is really overtaken as an idea. It's not an idea without merit, but I think in terms of application and the pros and cons of it, benefits versus the basis risk that you're running, it's probably something that's never going to have a huge impact. Although there, are likely to be situations in which it may be appropriate, but I don't think it's ever going to become a big part of the market.
And if you had a sort of wish list of things that could come, do you have a sort of sense on things that you think would be really key to sort of unlocking, making it easier for people to manage longevity risk?
I think if we could find a way to truly transition this into capital markets format, I think that would unlock a huge amount of flexibility, liquidity, and potentially additional capacity in a way that it should just facilitate a lot more deals, a lot more customization, a lot more innovation. I think that's probably the biggest potential impact on the market. It's also probably the biggest potential challenge to to figure out how to do that, given the structural impediments we have to that kind of transition.
And without putting you on the spot, and it feels unfair because I haven't put anyone else on the spot yet, do you think that will come? Will that be an innovation we'll see in the next few years?
In the capital markets, you never know. Look, there's been a lot of very creative thinking around this in the last 10 years or more, 10, 13, 14 years. And nobody's really cracked it yet. I think watch this space. I'll never say never, but I think it's an extremely challenging, extremely difficult problem to solve.
No, thank you. Very good answer. Very good answer.
Okay.
So one of the, I guess one of the other things that's been talked about recently in terms of structural developments for thinking about risk is the sort of role of consolidators, and of course one can think about them in different guises. Jay, obviously you may have a particular view working for an insurance entity, but I wondered if you had a take on whether those sorts of structures are things that pension funds will find useful, the role they may play, whether they're right for some funds, not other. Is that something you have a view on?
I do have a view. It's very difficult to comment because we really don't know what a consolidation vehicle really looks like, and in particular how it would be regulated, what the regulatory framework would be, how close it would be to insurance. I'm personally quite sceptical when I look at their offerings. Clearly they're quite sketchy, and that's kind of understandable because we haven't got a regulatory framework in place. But to the extent that they are promising exactly the same benefits as insurance companies, the extent to which they are for-profit organisations, to the extent they are there for the sole purpose of providing pension benefits, insuring them in some form. I find it difficult to reconcile that being very different to an insurance company. And whilst the consolidators would argue, well, actually they sit within a pension scheme, pension regime framework, it's that's a kind of a legal nuance. The man on the street's going to look at what they have to offer and kind of say this looks like insurance. And if that is the case, surely the regulatory framework around it, and possibly even the who the regulator is, should be the same as for insurance companies. And if that is the case, you kind of think, what's the point? So I'm kind of a little bit skeptical as to whether consolidators can offer enough of a difference to offer pension schemes for it to be worthwhile to invent an entirely new regulatory system and resource up a regulator. And if there is going to be a big difference, it's essentially has to be funded by offering less either less cover or less security. And I think that's difficult. Everyone knows what pension schemes linked with sponsors have been set up historically are there for. We know the kind of the shortfalls. We know what they're good at, and we know what insurance companies do. We know the level of security they provide, and so on and so forth. Consolidators sitting kind of halfway between the two. I'm not sure that's a sensible way for the industry to move forward.
Thanks, Jay. That's very, very, very interesting. So I wonder, maybe just to sort of start to wind down. You guys have done incredibly well, and no one's mentioned COVID. So so this is very, very good, because I'm sure sort of everyone's fairly sort of sick and tired of hearing about it. But maybe we'll sort of come around and I'll ask the question in slightly different ways to each of you. But just keeping with you, Jay. In any case, I'm just sort of interested in your views on kind of what's happening in demand and supply space for the products that you offer, kind of buy in, buy out. We continue to see some very significant predictions in terms of the volume that's coming. So I'd be interested in your kind of, I suppose, pre-COVID sort of take on the market and how that's going to go. But then interested in, have you seeing any change in the volume of business coming to you as a result of COVID? Has it changed the type of schemes that are looking to buy in? Be great to get your take on that.
I mean, what we're seeing is that tender processes for buy-ins or buyouts that are at a reasonably advanced stage are continuing to completion. We haven't seen many kind of fall over. We've seen one or two slightly delayed, hardly any that have been kind of put on ice. We are seeing, however, kind of a slowdown in terms of tenders that are at an earlier stage, and indeed kind of new inquiries coming into the market. That's entirely understandable, driven partly by companies having to think twice about their ability to commit cash to a pension scheme. Pension schemes themselves have to think quite carefully about their asset strategies, particularly if they're looking at a sort of a buy-in for a part of their pension scheme. Buyouts are also quite highly correlated to M&A activity more generally, and to the extent that is we'd expect that to be far less of that in the near term. We can see some fall off in demand. The expectation at the start of this year was that this year would be smaller than last year, maybe at about 30 billion. I think most commentators have probably sort of reduced their expectation to sort of 20-25 billion. Personally, I think actually even that might be a little bit optimistic. But we're certainly going to see business in the sort of high teens or early 20s, sort of billions of pounds, which would still make this year the sort of second or third biggest year from an industry perspective that we've ever seen. So generally, I think we should expect some slowdown in demand, at least in the near term, but still a pretty good, pretty high performing year overall.
And is there some commentators again have commented that smaller funds sort of had found it a bit more difficult in previous years because last year was dominated by a lot of large transactions. I suppose is that a fair comment anyway? And is it actually going to be a bit easier for those that are in a good position to move forward with transactions now?
I think it is a fair comment. I mean, if you look at the 44 billion or so that we were in last year, I think about half of that was 6 very large transactions. And to a certain extent, the smaller schemes were being squeezed out of the market. I think people have more resource capacity to be able to start looking at some of the smaller transactions. I think we're probably already seeing smaller schemes getting more traction, more quotes coming through. So yeah, absolutely. I think we'll probably see that is a sort of a sensible, good trend.
Thanks, Joe. Really, really helpful. So, Paul, if I can come back to you, as I say, be interested in your take on how you're reacting to the kind of COVID situation. I mean, one thing I wondered whether specifically you could comment on is, having done a sort of previous longevity swap transaction, is there anything sort of in relation to that means you need to think about COVID from a collateral perspective, or not? Just interested to see whether it sort of changed the way you think about longevity or the previous trade at all.
It feels a bit too early to say from where I'm sitting. I think there's a lot of uncertainty at the moment, and views around what may or may not happen with mortality tables in the future. I think we are conscious that this is a risk that is difficult to assess, and there's quite a variability over what that risk is and how you model it. I think it's fair to say that risk is even more uncertain as we sit here today than it's ever been. and I don't think we'll be making any immediate decisions at the moment until market thinking and practice has moved on. I think now is probably a time when you might get a good outcome, but you could easily make the wrong decision.
No, thanks, Paul. Very helpful. John, to turn to you. Is it a similar story? Are there any other things you're looking at, or that COVID's made you sort of think about as you review your sort of risk management strategies?
No, I mean, to be honest, for many of the older deaths we're seeing, we expect that to be just a short-term timing impact more than anything else, really. Harvesting, as it's called, where simply the person's dying 10 months earlier than they would have done. So I'm not sure this is fundamentally changing anything. I think one of the big things that, from a corporate point of view, that has changed it is just simply where the AA corporate bond yield sits. Things like that are quite important in terms of saying, actually, how does the sponsor's balance sheet? And when I did this at National Grid, we were funding this through the surplus we had in that balance sheet. It's a lot harder when you're just creating what looks like a much bigger deficit. So I think that's one of the other things to think about. Picking up on Jay's point, I mean, this is one of the most complex investment decisions you make. And there is always this issue about who's taking it. If you've got a completely lay trustee without professional trustees in there, that's quite hard. And that's often one of the reasons why smaller plans don't do this until they've moved into often a single corporate trustee that is doing this, a professional trustee that has the bandwidth and the experience, and then they can move this forward more rapidly. So I think there is something that is, by design, makes this quite difficult, whether in a COVID environment or not. But I haven't seen a massive impact from COVID. Fortunately, the number of deaths, while very sad for those impacted, is still relatively small compared with some of the big pandemics of history.
Thank you, John. No, well put. And you're absolutely right. I think to highlight sort of governance actually as being a very important part. If you look at schemes that have successfully completed their end game journey, generally the common theme, they're all sort of different shapes and sizes, but it's good governance and good decision making and good collaboration between sponsor and trustees. That's a good point. So maybe, Guy, I could sort of come to you for the sort of final comment. I guess interested in your take on COVID and I suppose what it may or may not do to both how you think about risks in a fund and also then the sort of solutions for hedging those risks.
Paul, I think I echo what Paul and John have said. I think the impact on our liabilities and how we think about life expectancy is pretty minimal, or is likely to be pretty minimal, as tragic as it is. However, where I think the impact is the greatest, and we're putting most of our effort in at the moment, is in what are the implications of this for the sponsor covenant? And what does that mean about the sponsor's ability to support risk-taking going forward, particularly over the short to medium term, be that risk-taking in an asset sense or in a longevity sense? And this is something, that we are more concerned about at the moment going forward. From a longevity point of view, we have a membership which is probably the longest lived of any pension fund. Our members are in the top 1% of mortality for the entire country, and it's this is something that we're focused on. Just understanding how that plays out, and could that get any worse from a point of view of living longer. But we don't really see COVID as being a big risk that would hit on the mortality side of the equation.
No, thank you very much, and actually, sort of, reassuring from all of your comments that COVID, as you say, despite having a very significant and negative impact on people, it's affecting, actually isn't disrupting your worlds of risk management, which is positive. So I think we'll draw a line under it there. Thank you very much for all of your comments, for being so open. Apologies for some of the slight sort of audio difficulties, and not least me leaving myself on mute once. But I think people will find that incredibly useful. So maybe it just leaves me to say thank you to Paul Jay, John, and Guy, for your contributions. And for those that have watched this, enjoy the rest of the conference. Thank you very much for watching and listening.